very good afternoon and welcome to this edition of Finweek Money Matters, the show that helps you manage your finances. I'm Bronwyn Nielsen. On the show today, we run the numbers and thoughts into investing as we delve into the top 200 and try to find value in the current market conditions. Then we unpack the social atmosphere and how companies can leverage off their social communication strategies, while more and more are traveling abroad for more than just the ordinary holiday, but for intense medical procedures. And no, that's not just plastic surgery. We discover more on medical tourism. Please do send any comments or feedback to moneymatters@abn360.com. In its cover story this week, Finweek looked at its annual Top 200 survey, where it unpacked a couple of growth versus dividend investment opportunities. With stock markets running hard at the moment, and it's becoming increasingly to find value for investors to take a look at how investors can differentiate between investing for dividends and buying into high growth companies, and how to spot which investment strategy works best for you. Joining us for this discussion is Finweek Deputy Editor Thandisizwe Mahlutshana, Keith McLaughlin, Small Caps Analyst at Tebe Stockbroking, and Wayne McCurry, Head of Momentum Wealth Portfolio. And thank you so much to you all. Of course, Mark Ashton as well, joining us in studio. Good. So let's start with your story, the rationale behind it.
Sure. So we do an annual survey. It's top 200. We basically take a whole lot of data points, use McGregor BFA data, and we try and interpret some of this data in terms of what companies are working and what isn't working. And what's very interesting, or as they say, lies and damn statistics, because often you look at data coming out of these, you can pull a set of data and you can try and make sense of it. But one of the problems you have previously had with this is that you could take a company like Decillion, which is essentially a cash shell as it stands at the moment, and it will score very highly in something like return on total assets because it is generating a return. It's got cash there that's now sitting in its assets. But what we've tried to do this year is try and actually make it a bit more interpretive. We've looked at things like dividend investing. We've looked at market capitalization. Obviously, there were quite big moves in the market capitalization space last year. And then return on total assets, which for me is it's a bit of a sore point for Finweek, because we look at the interpretation of assets and the ability to actually generate a return on it. So those were the main factors that we looked at. And yeah, we had a couple of interesting investment opportunities that we thought we'd unpack through the course of the cover story.
Can you allude to a couple of those investment opportunities, Thandisizwe, before we go any further, or do you want to throw it to the experts?
I mean, I just think that one just needs to look at the design of their portfolio construction and see if you want to invest for growth or you want to invest for dividends. And if I can speak for my preference, I'm one to invest for growth. I just think that dividends can be put back to the company so that the company grows going forward. And
Wayne, let's bounce that theory off you. Dividends versus growth. Is it that cut and dry in terms of the choice that you have?
It actually isn't. It depends on what phase you are of the market. So if you're in a phase where interest rates are falling, you've just had a big shock in the stock market, economies are shrinking, central banks are pumping in liquidity like crazy, and you think the world will survive. I mean, you've got to make that assumption. You think things at some stage will return to normal, then you go for growth shares. So when you start with the market at an 10, 11 PE, you go for growth shares with lots of money stimulus. But when you get into the later stage of a bull market where the liquidity is there already, the next move in interest rates is up, the market's at a 15, 16 or 17 PE ratio, then you start looking for dividends. So there's no one rule ever in investments, quite frankly. It depends on what phase you are in the market. And in my view, now you are in the dividend paying phase. You've got to take, generally speaking, higher dividend paying shares are less volatile than growth shares, because growth shares, there's a lot of what's going to happen in the future in the current price. And if there's any doubt whatsoever that future won't occur or won't occur to the same extent, those are the shares that can come under severe pressure.
Wayne, maybe if I can just jump in here very, very quickly. I mean, how does an investor make that decision? If you look at the Nikkei yesterday, in the last 48 hours, you've gone up 6%, down 3%. Yeah. It feels like it's promulgating the view that the market is a lottery at the moment, because there's a lot of the stimulus coming in.
Oh, definitely. I mean, there's no doubt about it. I mean, I don't like the Japanese market simply because it can go up 7% in one day and down 6% the next day. And the Japanese economy is, at the end of the day, actually broken, more so than the European economies. I mean, there is just so much debt in the system there. So Japan, you know, we've certainly steered clear of it for multiple years now, and I think that is the right view. But it is difficult for investors to determine, I suppose, what phase they're in, what shares to buy. But there's no rocket science to this. You must just apply your mind and do a lot of reading and do a lot of investigation into it. I mean, if a company is at a 50 PE ratio with a 0.5% dividend yield, you had better truly believe in the future outcomes, and you must buy it 100% before you buy the share.
Keith, let's bring you in here. And first of all, give us a little indication about your universe. Do we see the small to mid-tier companies being prominent in the dividend paying space or not?
Absolutely not. Just touching on what you said, then I'd like to elaborate on what Wayne mentioned. Unlike the top 40, where I think almost every single top 40 company has a dividend policy, sticks to it, and almost consistently pays dividends, except for the Anglo curveball.
And we saw what happened to that share.
Absolutely, absolutely. Outside of that, as you go lower and lower down, the earnings quality becomes more and more volatile and the like, and the cash flows, and even the growth rates become elevated and the companies have to reinvest. So no, absolutely not. There are a lot more growth stocks versus dividends, the ratio, than in the lower tier stocks than in the top 40.
But which makes perfect sense, because that's what you'd expect. People would be investing to create that growth momentum.
Absolute textbook growth cycles of a company. But elaborating a little bit on what Wayne said, he has a little bit of a different perspective. I went back and I crunched 18 years worth of stock market data, and the capital...
Specifically for this show?
Yeah, it's easy to do if you know how to do it.
Right. Well, it sounds very impressive, Mark. I was going to say you've really got people wrapped around your finger.
So the capital growth year-on-year average over the last 18 years on the JSE was 14.3% year-on-year. The dividend return year-on-year was 3.5%, averaging over the entire time. Now that sounds very low. So capital growth sounds really attractive versus dividends there. Now let's actually break it down, because the market is a risk-reward relationship. It's not just returns, it's risk-adjusted returns. So if I go through some rather complicated steps, but you end up in basically what they call Sharpe ratios, which is risk versus reward, you actually arrive at the conclusion that capital growth generates 4 times the return that dividend growth does, but at 7 times the risk. And you step back, and this is where I'm going to start to agree with Wayne, is you can see the capital stocks, growth stocks, are basically bull market stocks, where the multiples in the market lift up dramatically, and you'll see those run very, very aggressively. But they are not bear market stocks. So in the massive dips and the massive corrections and the like, you want to preempt them and be in dividend yielding stocks that are much, like I said, the return there is much lower, but at lower risk as well.
Sure, but can't it be difficult though, and argue that that's a South African market phenomenon? It's 1994 all the way through to 2013. I mean, if you look at more developed markets, real return comes from almost 80. I think it says almost 80% of real return comes from dividends in the long run. And I think that we have a slightly warped situation in South Africa, in that we suddenly did open up our market to a whole lot of new entrants. There was new investment. We kind of had the BRICS thing going for us. Isn't that just a phase of being a baby market, though?
Not disagreeing with any particular point there, just being a bit of a devil's advocate. In my opinion, the argument is actually null and void. What you want is you want undervalued stocks. End of story. Be it an undervalued stock based on dividend flows or undervalued stock based on versus future growth prospects. It all depends which way you're willing to look at it, and it comes down to valuation. That said, this story can show us that if you're going after capital growth or growth stocks, your portfolio will be more volatile. So you need to be able to stomach that.
Wayne, let's get your thoughts on Mark's comment there.
Look, I mean, as Mark said, there's lies, damn lies, and statistics. If you look at the big overseas markets, they've done nothing for 10 years. I mean, they're only now hitting new highs that they did 10 years ago. So all your return was dividend. So when you look at the last 20 years return on the US markets, your statistics are going to show you that dividend's the way to go. But it doesn't mean the next 10 years, the next 20 years is going to be the same. I mean, you're starting off certainly a year or two ago at very low valuation levels in developed market share markets in particular, for very good reasons. So now the next 10 years might be characterized by growth. I mean, I know it's extremes, but the extreme PE...
But hasn't this period been characterized by growth?
Not the last 10 years, no. Only
Not the last 10 years,
period.
but...
Very short time period, yeah.
But aren't we about to change? I mean, you now look at the growth versus value investors.
I don't-
Value's been underperforming for such a long period of time, and
Not
ultimately...
overseas, eh? Overseas value's actually been a very good investment. It's domestically that value's been bad. I mean, the US market in 2002 was at a 40 PE. Now, I know that's an extreme. You know, literally a year or two ago, this thing was lurking down at a 14, 15 PE. So you have been pounded. Your growth shares have been destroyed over that time
Right,
period.
but what about the South African environment?
Oh
then?
no, we've been a total growth environment. That's why you
Exactly.
should
So
go
now,
for value.
I know that we don't have any crystal balls, but what I'm saying is that it's cyclical.
Yes, it is.
Ultimately, it will change.
And ultimately, growth value or value investing is dividend yield investing. They are essentially the same thing.
In the current market, so where do you want to be? Do you want to be overweight dividend growth, or do you want to be overweight capital
Well, it's
growth?
interesting. There are almost two categories of dividend shares at the moment. There's the distressed dividend shares, JD Group, Fushini, Lewis. I mean, these things have got a high dividends. African Bank.
And the question is whether those
Is-
dividends
is
will
your-
be maintained.
Whether they can be maintained. So there's distressed dividends. Do your homework before you buy them. But then there's the normal dividend payers, the cell phone companies, the banks, Nampak. I mean, I'm not too sure whether you can put PPC in that basket. That might be also a little bit of a distressed case story. But then there's almost the compound dividend guys. And I think at the moment you must go into the compound dividend guys. I used to, up until literally a month or so ago, include the life assurers in the compound dividend things. But those shares have run massively hard, and now they've come off massively in the last 2 weeks. Maybe in a week or two's time, they might be back in the, let's call it the stable dividend camp.
Mark, give us a little more insight into the article.
Okay, great. So we have a couple of, we started to try and pick a couple of the shares that really jumped out for us. Able, we've touched on quite a lot in the last couple of weeks. Shares that jump out for us, Naspers is an interesting one. And there's an interesting discussion around what Naspers does with its dividend, because at the moment it sits on a 0.5% dividend yield. Relative to, let's say, Apple, 2.6%. So if Naspers were to change its dividend structure, would it make it more interesting as an international play? Steinhoff getting a lot of interest around it as a growth.
Well, you know what?
perspective.
Let's take this stock by stock, get their views on it as well.
Well, the challenge with Naspers particularly, there's a huge amount of its value sits in companies it doesn't control. Sure. So it can't access their free cash flows, and hence it doesn't have free cash flows necessarily to pass on the massive dividend versus its net asset or sum of parts value. It does, if you look at its dividend versus the operations it does control, it actually has a very generous dividend policy. But a huge sum of its value is really Tencent, which it doesn't necessarily get free cash flows out of. So that is a bit of a distorted market stat, and that's also why you can't look at these big numbers without looking at the granular detail.
Fair enough.
Wayne, anything to add on Naspers before Mark takes stage?
I buy the Naspers story. I bought it for many, many years, and the shares have done incredibly well. But a 50 PE, this is just not shy. But plenty of people who've been concerned about Naspers have been wrong. But at a 50 PE, this share has run seriously hard.
In other words, take your money and run potentially at this stage?
Maybe take half your money and run.
What about a share like Discovery? I mean, Discovery is a company that has been, it's been going through a big growth phase, but it has upside to it. It's got big markets, it's got things like China, it's getting its UK operations, right?
This Discovery's got to do a new deal every 2 or 3 years to maintain the share price. Very low dividend yielding share. I think it is particularly expensive at the moment, only because it's run so hard.
Yep.
So I wouldn't be a great...
And a Vodacom versus MTN agreement, because this is again this discussion about Vodacom's a good example of a company which has consistently just delivered just a little bit more than most people have expected on the dividend front at least. MTN's been the growth story. Suddenly it's out of favour because of a lot of its political issues around some of its operations. Which is your pick?
Look, you've got to be brave to go invest in Burma, in Myanmar.
Fair enough.
Yeah.
But additional risk, additional reward.
No, they're in fairly exotic places. But actually, I like both of them. I think they're both fairly priced. I wouldn't actually choose between the two of them, to be honest.
Keith?
I must say I prefer MTN, whereas in the domestic market, obviously, is a lot bigger in Vodacom's world than MTN's. The domestic market has increasing pricing pressure and deflation, where MTN, some of its further flung regions at higher growth rates, it has stronger pricing power and higher margins. And that makes it, in my mind, a much more attractive, but a long tail dividend payer, because it's still in growth phase, whereas Vodacom's trying very hard to look like it's in growth phase, but it's actually almost ex-growth with very low capex spend and high free cash flows.
Try to see where, let's bring you, bring you in now.
Yeah, I think Famous Brands has also been quite an interesting story over the last year or two. How do you find the share?
Although I particularly like Famous Brands, I think it's built an incredible moat around itself, where we've got Burger King rocking up and the like. But it's great to have a good brand. It's very hard to have thousands deep distribution network. And you can't get that overnight. Famous Brands has that. So it makes it very, very strong, very, very defendable. And I think the 10, 20-year story is that Famous Brands start becoming an African play. It's African operations rolling out more and more of those franchisees and the like, and slowly and steadily the growth will be there, whereas it'll just have a comfortable base in South Africa.
Okay, so here's a question then. We've got the situation with Famous Brands versus Spur, which has been a debate that's been going on for ages. The argument's always been Spur's been very lazy about what it does with its balance sheet and its operations. Famous Brands has been far more geared in growth. What are the signs that Famous Brands is slowing down versus that Spur is suddenly starting to optimize its balance sheet? What do investors look for from that perspective to say they're actually sweating their assets?
Well, often the dividend yield will give you an indication of where in the growth phase a company is. And Spur's always been a very attractive dividend yield. Famous Brands, you never bought it for the dividend. You bought it for that capital growth. I think, and technically they're playing in very different market spaces. Spur's sit-down family, and they have bought one or two others, but they sit-down family, sort of mid LSMs, where Famous Brands almost everything else, except for that. So I think, it's a tough question. It very much depends what you're looking for. Spur's got a fantastic return on invested capital. Actually, arguably better than Famous Brands, depending on which time frame you look at it. Famous Brands, though, has a much better growth record.
Unfortunately, the time is up for this segment of the show, but gentlemen, thank you very much. An interesting discussion. That's Keith McLaughlin, small caps analyst at Tebe Stockbroking, and Wayne McCurry, head of Momentum Wealth Portfolio Management. Now, you can read more about these stories and many others in this week's edition of Finweek on the shelf from today. The magazine is also available digitally in English and Afrikaans via mysubs.co.za. That's mysubs.co.za. Time now for a quick look at our Finweek trade of the week. Mark, are you doing the honours here, or
I'll have a crack at this one because this one I have a little bit of a vested interest in. I bought into the Trustco story a couple of almost a year and 2 years ago, and it was low 20s, I think, at the time. It's now had a really good run up. It was sitting at about R1 a share. Put out a trading update this week and fell off. I think it's about 85 cents a share, but that's quite a significant pullback. Trustco is quite an interesting business in that one, it plays in the Namibian space, and it's quite dominant there. Sits on a PE, I think, about 3 times earnings, and a dividend yield is what Keith, about 4.5%.
Well, that's historical. We'll see what it looks like after this.
Sure. So, but you've got this really nice little business that is generating money. It looks cheap. They've got a nice property portfolio which actually underpins it. I mean, they own all sorts of funny things. Well, they've got like newspapers and that kind of thing that they need to get rid of if they want to optimize the business that they've got there. But it just, to buy a business on a 3 times earnings multiple seems very, very attractive at the moment.
Just remind me again, you bought it initially at R1.
No, I bought it at 20 cents.
Oh,
I got
you bought it at 20 cents and you got it up to R1.
Yeah.
I was going to say, I'm not quite following you on the graph there because we had 86 cents now.
And as I said, it has fallen off after the trading update. So we
buying opportunity is what you're saying.
Buying opportunity is what we think, yeah.
Mark Ashton, Finweek editor, is leaving us now as well, and it's time to pay the bills. We'll be back right after this short break. Well, as social media fatigue sets in, companies need to consider their social comms strategies more carefully. These days, it is about far more than simply being on Facebook. It's about being an actively engaged brand citizen, and we will unpack what this means and how your business can become truly social in the current context, both digitally and offline. Tade Sizwe still joins us with Jessica Hubbard as well from Finweek, and Andy Rice, brand strategist, and Craig Rodney, CEO of Cerebra, joins us for more. So what do we mean when we talk about becoming brand citizens? Do you want to give it a kickoff?
So in the online space and as the social space has evolved, we've realized that the technologies and the conversations are human conversations. Brands have had to learn, as socials evolve, they've had to learn how to be a bit more human and a bit less brand. And that's the major crux at the moment.
Andy, can we bring you in here and talk a little bit about the social media fatigue? Do you think that companies are now saying, actually, to hell with our social media strategies, or are they really paying attention?
No, I think it's growing, but I think perhaps what's happened is that they were set too high expectations at the outset, so they got tired of things not being realized, but then they were never going to be realized at those levels in the first place. But I do think this concept of brand citizenship is used slightly ambiguously, because I think offline it means something very different to it means online. And I'm very interested particularly in the offline component. I mean, Craig obviously is very keen on the online side, but for me a brand citizenship concept is about brands understanding that they are no longer just a facilitator of transactions and therefore they operate in a category, but that they are actually social citizens and they have to make a difference on the society, the broader community that they operate within. And that requires a sort of evolution of traditional social responsibility interventions into something that's much more linked to brand strategy.
Jessica, can you share some of those Finweek insights in terms of the article?
Sure. Well, what I've found is that companies are looking at their social media strategies and trying to convince their exco to allocate budget to a comms agency or something, which a large part of the budget is starting to go towards digital. But they want to see, how is this going to benefit me? And there's too often an assumption that because a company has 10,000 Facebook likes or it's got 10,000 Twitters, that it means it's doing well on the social media front. But I put the question to Andy and to Craig, what does this really mean? Do 10,000 likes on Facebook actually translate into higher sales? Does it translate into brand awareness? Because quite frankly, I don't think excos have the budget, to waste anymore on these sort of frivolous strategies.
It's always an interesting topic, and I think working in media, you always realize that there's the debate of, is print media dying or is social media taking over? And I think South Africa has a history of adopting new technologies quite late. And if you look at the current environment now, companies' revenues are stretched, and spending that money without knowing if you will get a return back. And I think with social media, there's always the question is, I put in a budget of 500,000, for example, and how will that translate to more sales? And there's also a question of how do I measure, or how do you measure the efficacy of all this spend? How far are we in terms of answering those questions?
How do you measure it?
So I agree. The number of fans on Facebook and number of Twitter followers is becoming increasingly irrelevant measure. A lot of the measures that we look at map back to what the client strategy is in the first place. So a lot of our clients use social media as a conflict resolution area. And so we can measure the number of calls that are diverted away from their call centers. And that's a real cost. And when you're diverting a couple of thousand calls a month and you're managing those conflicts via a social channel instead of having a team of people at a call center doing it.
Is that where the value comes in, conflict resolution?
Well, that's one of the values, because that's one of the ways that one of the ways companies use social and human beings use social. One of the biggest things that our clients get out of social media is the ability to do market research and listen. A company like Vodacom say, they have upwards of 50, 60,000 brand mentions online. These are things that people are saying about them. We're able to interrogate that information and go back into them and say, this is what people are saying about you. These are the products that they enjoy. These are the products that they don't like. These are the things that they want. And Andy will tell you, that kind of market research, if you're going to have a team of people phoning around random people, that's now available to them.
And then you use that market research to change your product to try and get to the sale.
Yeah, I mean, back to Jessica's point about the number of likes, I mean, more and more companies are incentivizing people to like a Facebook page, which is so artificial it's untrue. But the qualitative research is really valuable. I was working for a big retail client recently, and I just, prior to a meeting, did a search on Twitter by their brand, and just took the last 15 or so references to their brand on Twitter. And not one of them was about the merchandise they actually sell. Everything was about their experience with the brand. The Boerewors roll for sale in the car park. The people saying, oh my goodness, my husband's gone into, it was Builder's Warehouse actually, gone into Builder's Warehouse, what am I going to do for the next 3 hours? And all of these things, nothing was about wheelbarrows being 20% off till Saturday. It was all about how they relate to the brand and the experience. And that's what you can get from qualitative research through online platforms.
So you want to add?
Yes,
Craig?
well, I want to challenge the idea around this social media fatigue. Consumers aren't suffering fatigue from social media at all. It's actually the opposite. More and more people are flooding onto social media. From a brand point of view, a lot of brands rushed in early. They went in because they saw everyone else doing it and kind of went, we've got to do it. Like we have to. And it was more of a panic decision. Thankfully, we're getting to a point now where the decision making is reasoned, and we're moving away from social media and we're moving towards this concept of social business. Social media is where you have a Facebook page. Social business is where you understand that you have information age customers and you need to have an information age business. You can't